I'm back with our founder, president of Wagan Holdings, Patrick Bagan. I'm Brandon Guderian, head of finance. It's a 5-part series that we're doing where we just chat about how we as Wagan Holdings underwrite prospect deals and what's that look like, just to show a little bit of transparency to the process. We also take pride in it and we kind of geek out on it. So as much as we can tell other people about it, I think it's a win for everybody. So this is part 2 of a 5-part. First one, we talked a little bit about just how do we look at underwriting deals at the highest level, relationship with brokers, how do we find deals? Now it's, so you got a deal. Maybe it's under contract, maybe not quite yet, but how do we look at it from a rental comp perspective? How do we look at the revenue within the deal? What's our renting pro forma and strategy? So that's what we're gonna unpack a little bit today. The top line revenue, as some folks in finance would say. So, because it can be so arbitrary, and we've seen a lot of different deals out there in pro formas, it's like a fiddle. You can play it any way you really want in an Excel model. But just to start, let's say we got a deal, how do we look at finding or pressure testing rental comps in our pro forma compared to what maybe the seller has in their historical experience and what's happening today?
Yeah, so really we're going to look at like what's going on within the unit. To start off
the quality
more than anything.
So you're walking the units too, right?
That's right.
So,
Yeah, we're going through every single unit that we can
pictures,
that the broker will let us, which a lot of times is like 4 units on 100 and something unit deal. And so like making a best guess off of that and being aware of the fact that there's probably some revenue or not revenue, but expenses that you need to add and raise for to be able to cover those things, and being cognizant of like how much rent you're going to get on the back.
Because I guess it's like when we talk about it, when we're looking at a deal, I'm sure folks have heard the term value add deals. Essentially, it's like when you're talking about walking a building, looking at a building, looking at the units, you're trying to say, okay, where are the units at today? Where's the rental market at? And how many dollars capital do I need to invest to get there? The value add play, right?
That's
So
right.
you're kind of assessing that out in person, as well as then getting into a model and trying to pressure test it financially too.
Yep.
Right.
So maybe we just start with like, where do we start and where do we kind of build from?
Yep.
So when we're starting, we're going to look at like day one, when we take it over, where do we sit? How many units are empty? How many units are rented? What rate are they rented at?
It's like
how large are the units?
Like inertia of sorts. Like what's the run rate?
Exactly.
Without us doing anything.
Exactly. What's the fixtures inside of those units? How do we look at those? Then we're going to see where do we fit in the market as we stand today, and how can we move up or down that market. And so
so how do you find those comps to know where you can move up?
There are a ton of public sources out there that you can start with, and things that you can pay. There's like a tiered system, right? The things you can do for free, the things you can do
for $10 a month,
exactly,
or whatever it ends
and then
up
the things
being,
that cost you a little bit of money, and that's like the cheat code partnership, and we'll kind of get into that in a second.
Okay.
But tier 1 is going to be like apartments.com, Craigslist, Hot Pads, like all those websites are out there. Zillow is another great one. Like they're the places that we list our apartments on, so you know what you're getting for rent. You might not know the fees that you're going to be paying.
Or it might be a little, depending on how folks update it, it could be a little stale.
Exactly.
But it's a number that you can.
But that's your base rent.
Yeah.
That's the rent that we're indexing all of our future rents off of, no matter what fees we're adding in, because that's a whole nother set of revenue pieces. But specifically looking at where do you fit now on that tiered system in the free space. And then we also we've also paid for tools that help aggregate some of that data. And so like we use Rentometer.
Yep.
Is that necessarily the best? The one thing I have an issue with from Rentometer is you can't see the fixtures. There's no pictures that come with the property.
One dimension of many dimensions.
Exactly. But it does identify who your direct competitors with, who has units available. And then you can use that to go to those free sources and see, oh, this is what the inside of these units look like.
You can follow the breadcrumbs sort of that way.
Exactly.
Okay.
And so that's key number 1 is where do you fit in the market on those kind of tiered systems.
Yep. Kind of like a smell check almost.
Exactly.
Like here's where we're at. Initially populate like an investment case.
Exactly. Yeah. And I guess we'll give away the cheat code early on.
Yeah, why not?
Top tier.
Start with the punchline.
The top tier is having a great property management partner. If you are doing deals and placing, like, we're not a property management group, and we don't pretend to be.
No.
We're an asset management group. We're an asset buying group. We know how to maneuver the buildings and how to fit them into like our pro formas, but we don't know how to like the people aspect of it, running that the appropriate way.
Yep.
And we rely on partners. We knew that getting into it that we weren't going to be that group. But relying on a management team and having them as like a great partner and knowing that you're going to keep putting deals with this property manager, that's the cheat code.
Well, and because they're managing buildings, so they not only have, let's say they manage 1,000 units in an area, they know the rents they're charging, but then they also, to your point, they know the units, they know the fixtures, all the stuff that comes together, and they can be a strategic partner.
That's right.
With you in that.
That's
right.
That's
super powerful. Right?
Yeah. And I say that's the highest tier because you pay for that.
Yeah.
Right?
Yep.
You're paying them money to manage your other buildings, but in turn, they know that this relationship will continue to build and grow. And so then they're more willing to play ball with you and
Most
spend
certainly.
some time with you, knowing that you're going to grow your business with them simultaneously.
Yeah, it's a true partnership in every spirit of it in that regard.
Right. So I guess then after we kind of fit those, like after we know what today's rental landscape looks like, where do we think we can move up the chain? Where's that value add piece going to be that will move us into the next piece? And how long do we think it's going to take us to get there?
But for a dollar, the hypothetical dollar spent, how does that look on the return profile?
Exactly.
Right.
And so when we're looking at things, we're going to look at like rental price per square foot. How are we going to index that upwards? Like, what are we going to do? A lot of that times that's going to be getting into the units and making changes to the units.
Yep.
Sometimes it's going to be adding amenity features that are going to drive in maybe a different type of tenant base.
Yep.
Right. But for the most part, it's going to be inside the unit, what people look at every single day. You're going to be looking at upgrading the countertops, putting in new cabinets, putting in new floors, things that have like pretty expensive costs, but the add back on revenue is
if you know
huge.
You can get $100, $200 per month per unit, you can do the math and say what is the value to that in cash flow in a year,
exactly,
year over year, and what can that do in terms of the value of the building and appreciation.
That's right.
And you can do that triangulation.
That's right.
And you can do that pretty quickly too once you get the numbers right.
That's right.
So I guess my question would be, and especially we both have corporate backgrounds in more of the financial pricing realm, and so we kind of know that. And we love making models. That's one of our passions.
Sure.
We've had some late nights building models over the years.
We have.
So, and I wouldn't trade them for anything. But we also know, out of full respect, that sometimes the day after a model, it's already old.
Yeah.
So let's say we're off on a projected rents. How do we look at deals where the bottom doesn't fall out? Like how are we finding that nuance and trajectory if we're off on rent? Because you never know the whole story, and at the end of the day, it's a forecast and it's an estimate.
Yeah. So really, we're going to be prepared for that because we do sensitivity test it.
Sure.
So we're coming up with like, what's our best case? What's our medium case? And where is like the base case?
And within
base
that,
case being like just straight up trend. Rents increase over time. Historically, they have not decreased over time. Whether it's 1% or 3%, knowing where you fit into that range.
And also you got knowing your market, because some markets are much more volatile.
That's right.
Where we're at generally where we choose to play is a little bit more stable.
Yes. Right. Very consistent year over year. Another reason why we like the Twin Cities market.
Yep.
And so knowing that like in that worst case, how is that growth going to be? That's kind of what protects us, because we're setting our offers based on the fact that like we know we'll do something to get this done and to move these numbers. It's just like, are we going to move them to the point of the medium tier? Are we going to move it to the top tier?
And when we communicate with investors, we want them to know what is the overall spread or sensitivity within the model. Like I know we had built one, and I was just talking to an investor last week where, they'd say, well, what is the conservative scenario there? Whether it's revenue and then also expenses to the whole buildup. And I essentially said, well, we try to identify all the levers. We do a full analysis, and we say, okay, the conservative is if almost every single ball doesn't bounce our way. We want to make sure we're still okay and it's a decent profile for a return perspective, and we're doing right by the building and the people. And
that's right.
Then we kind of stack it from there, right? Revenue is one of those things within rent comps, correct? Okay. Yeah. So like fees, you can be creative on fees, how you charge back certain utilities. Yeah. What's your perspective on pets? Oh, so we've talked about ancillary revenue, like with internet chargebacks. Like how could you, there's a lot of creative things you can do in the revenue space beyond just the base rent.
Yeah, right.
So, and that's what kind of makes it fun. So
it's like the interesting pieces that you can kind of add along that make it more interesting.
Exactly. So I think as we kind of wrap it up, again, part 2 of this 5-part series, we've kind of already talked about it, but kind of the last, leg of this stool is like, how does this come together in the underwriting, right? Like, so let's say you got all these different variables, you've thought about scenarios. Now, what do you do? Are you like, because you spend a lot of time, and you and I have both, like, we're adjusting certain nuances in there. What is that process like, and what are you looking to do? What are you solving for usually?
Yeah. So every deal that we're doing right now, for the most part, is going to be some sort of value add play.
Yep.
Have we looked at some new construction deals? Sure. Do we think we're going to get those ones done? We're not really leaning on those. They're kind of just fun deals to think about.
Yeah, we haven't done those before.
Yeah, yep. But the deals that we have value add pieces, we're trying to figure out, like, what is our stabilization period and what are our stabilized rents.
Yep.
Right? And so that's our middle tier of our rent profile. And so the rent profile from day one is, what are the rents right now? Rent profile part 2 is, where are we going to index to in the next 3 years for like a stabilization?
Yeah, okay.
And so that's like getting vacancy back up, or down, I guess. And then making sure that you're putting in tenants that are going to pay you.
Yeah.
And then lastly is putting together your value add strategy. Where are you going to put in construction, and how are you going to get those rents to kind of pull those pieces together?
And what does that look like between years 4, 5, and 10?
Yeah, right.
Because what we've seen across the properties, the various properties that we've owned, is that when we're able to kind of talk about that stabilization period of the first 2 years, when you just do right by a building and the people in it, and you get the right mix of people that abide by leases, right, and you treat it right, like the financial profile falls into place.
Yeah,
right?
For sure.
Because we're not looking for quick dollars here, about long-term sustained returns, doing right by those 3 components. And so I just feel like that's the fun part about the stabilization period, but that's not the full upside, right?
No.
Then it's like when you go to that projection year 4 to 10, that's where things can get pretty transformative from a return perspective.
Yeah, exactly.
Right?
And like, there is opportunity in those years 4 to 10 that we just don't even pretend to capture, because we're really just focused on, like, okay, now how do we just have a consistent run basis?
Yep.
And so in those years 4 to 10, we're probably only trending like 2 to 3% on rent growth, which is probably a pretty conservative metric, because there's definitely some years where you'll see 5%, and there's a couple of years where you'll probably be stuck at 2 to 3%.
Sure.
And so just trying to recognize that, like, we know we could probably do better in the future, but let's just, like, what's our true north, and how do we kind of follow that?
And we tend to, if we're ever at a conflict, we bake in conservative, right? Because again, we're trying to be transparent and do right by our investor group when we're having these conversations. And so, like, as much as we can be transparent, and as we're having conversations with folks, if they want to see something or talk about it, we're more than willing to do it.
Yep.
We actually welcome that as well.
Yeah,
so
for sure.
And again, I could talk about this all day, but we can wrap up this part 2 of the 5-part, and folks can look forward to part 3 coming up soon.
Yep.
So
yeah,
thanks, Patrick.
Sounds good.
Appreciate it.
Yeah,
Take
thanks,
care.
Brandon.